Good morning. Welcome to Stock Market Today. It's Wednesday, January 6th, 2021. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. I get a lot of the content for this show from there. We also give you daily stock ideas to consider. Hits your inbox every trading day before the market opens. U.S. equities higher on Tuesday, rebounding from Monday's sell-off. Actually finished yesterday just off the best levels of the session. Energy, materials, and industrials outperformed. Sound familiar? Cyclical rotation, groups we've been talking about for months now. Laggard were the defensives. Remember our charts from yesterday about the defensive areas? Well, they lagged yesterday. Treasuries were weaker with the curve bear steepening. 10-year break-evens pushed through 2%. Those are break-evens. 10-year yield pushing through 1%. But 10-year break-evens pushing through 2%, that is a sign of investors anticipating inflation. That's another theme that should sound familiar to longtime listeners of my shows and readers of my work. The dollar weakened on the major crosses. Surprise, surprise. Gold finished up 40 basis points. Crude oil added nearly 5% yesterday. Saudi Arabia, 1 million barrel per day production cut for February and March surprised the market. Energy ripped higher. If you recall, we've been talking about warming to energy. S&P futures, as we get to the desk this morning, are down 30 basis points, while NASDAQ futures are off about 1.7%. Dow futures are up slightly, and small caps are ripping topside. Treasuries were under pressure again. The curve once again bear steepening. 10-year yields push through 1%. As I've said, that's the first time in 9 months that that's happened. So it's an interesting development. I have an interesting view on it here. We're going to touch on it later in the show. Dollar is stronger against the yen, lagging the euro and sterling crosses. Gold up 30 bips. WTI crude adding on 1.1% on the day. No real change to the structure here. I'm getting tired of saying it, but I'm not going to make something up that's not there. We had a rebound yesterday. We could see some election noise today, right? Democrats look like a bit of a strong showing down in Georgia, leading some to believe increased spending. Obviously, rates are going higher. Rates go higher. Not the best look in the near term for growth-oriented equities. Why is that? Well, just do your bond math, right? Think of growth equities as companies whose earnings are out in the future, right? You're paying a multiple now for the prospects of fast growth into the future, where the companies will hopefully become profitable. Well, the further out in the future are your cash flows. If you begin to discount those cash flows at a higher rate, i.e. higher interest rates, you get a lower present value. Growth stocks more sensitive to rising rates than our value plays. So it's one of the reasons we've been talking about having a balanced approach. Those who have been reading my work for the past few weeks, I've been saying it, a balanced approach. It's not just growth. It's not just value. It's not just large. It's not just small. There's opportunities everywhere, and you want a balanced approach to a portfolio. Here's why. If you are heavily levered growth today is going to be a painful day more than likely. If you're a little more balanced, if you're a little more nuanced, if you've added some of the cyclical, some of the value, some of the small into a growth portfolio, you're probably going to have a better day today. Support levels and key levels of interest remain the same for the indexes. I really wanted to touch on that because it's something we've been talking about. It's something we pay a lot of attention to, right? When you think about equity strategy or market strategy, this is the difference between thinking about a portfolio in a holistic way. And then rather than taking a scattershot approach because you saw somebody talk about this name, some other newspaper likes that name. Next thing you know, you have a hodgepodge portfolio, and you don't really have an understanding of how everything kind of works together, goes together, and where your kind of risks are, right? From a factor perspective, today is going to be a tough day for growth, more than likely. And if you're heavily overweight growth, today is going to be hard, more than likely, with the backup in rates. You can see it. The Qs are down nearly 2%, right? That balanced approach that we've been advocating for the past few weeks, likely going to do its job today. Let's hit our market in a minute. What are we writing about in our note to Chaikin clients? Well, small caps continue to lead the bullish charge. That's kind of interesting, right? But again, balanced approach. Election runoff volatility could create opportunities. I do think bigger picture, we make a lot out of elections, but generally speaking, they're just noise within the context of a bigger picture trend. So I think that volatility could create opportunities here in the near term. Sentiment more neutral this week as some froth is skimmed off the top. We'll talk about what that means. Looking for dividend funds in a low yield world, we're going to take a look at RDIV, RDIV today. And futures, as I said, point to a mixed open. Major indices from a power bar perspective, everything higher yesterday except for bonds. Dow up 50 basis points, 4-2 bulls to bears. S&P 500, 123.64. You can see the numbers here. Nas was a slight outperformer. Small caps outperformed again. I mean, at this point, if you can't see the trend is underway, I don't know. No sense fighting it. Bonds downtick, send yields higher. Again, 10-year pushing through 1% here this morning. And energy, your big sector yesterday with that Saudi Arabia surprise cut. 4-2 bulls to bears there. There's been opportunities. Remember, I highlighted OIH on this show yesterday. And hopefully some people took advantage of that. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bullish. Major indexes are mixed. Let's hit our stock of the day. I think you're going to speak. This is kind of an instance where I think you're going to get an opportunity. AMAT, I love the setup here in AMAT. Trading near 52-week highs, overbought, oversold indicator rounding higher in an oversold position. Solidly outperforming bullish stock. You know I like the semis. We talk about them all the time. Trend is strong. Industry is strong. Money flow could be better, but big picture, weight of the evidence, AMAT looks compelling. It's probably going to open lower today. I think it's an interesting opportunity here within this consolidation zone to play for further upside. So again, this is part of having a balanced approach. I'm willing to look at everything. If you came in heavy growth today, if you came in heavy tech today, it's going to hurt. If you didn't, well, you can pick up some opportunities in names like AMAT. Take a look at Applied Materials, AMAT, and watch how that one trades out today. Sector tracker now, movement of the last 5 days for the major sectors of the market. Energy, materials, top of the list. We've been talking about the rotation. It's been interesting, and we watched it play out, right? I mean, it was materials early in the summer, industrials late in the summer, fins in the fall, and now energy. It's kind of fascinating, right? And again, I think it speaks to, number one, paying attention to this stuff on a daily basis. Number two, understanding that it's not a flip of a switch, right? It's not risk on, risk off like that. It's not growth value. It's not, momentum beta. These shifts happen gradually over time, and you watch them and they play out, and you just start to adjust. Healthcare is an interesting group, as we discussed yesterday, and we'll look at a little bit further because you have to drill down there. Fins, curve steepening, good for the banks. We've touched on that numerous times. Discretionary also higher. REITs, comms, tech at the bottom of the list. Industrials, staples, Utes, middle of the road. Not a ton to talk about there. You know my views. Industry in focus, healthcare services, 25-0 bulls to bears for this group that's outperformed the S&P 500 by 22.5% over the past 6 months. It's ranked number 3 of 21 subsectors, up 6 slots in the past week. McKesson, the Providence Services, and National Healthcare, MCK, PRSC, and NHC, respectively, with very bullish ratings, are holdings in a fund that, that's textbook off the March lows. That is your definition of an uptrend. Bullish ETF rating, strong trend, getting close to an oversold position, solidly outperforming the broader tape. And so if you just looked at healthcare, you'd see a group that doesn't look great. But if you did the work and drilled down, you'd find these groups like equipment, which we looked at yesterday, and services, which we're looking at here today. Let's hit what's trending now. Yesterday's S&P 500 gainers and losers, our movers and shakers. Left side of the board, the leaderboard, you should be able to see the theme. If you're not familiar with all of those ticker symbols, they are all energy related. Occidental up 10%. Now I have bullish exposure to Oxy via call options. So full disclosure, I am long that stock, up 10% yesterday on the energy pump. I like Oxy because of the activist investor that's in there as well. For anybody who's interested in taking their analysis, I suggest reading up on Oxy. Diamondback mentioned positively at Tudor Pickering Holt, up 9%, also with the energy tailwind. Apache APA going to a holding company structure that might allow them to buy some other assets. 9.5% to the good. MRO, also a positive mention at Tudor Pickering Holt, up 9%. Halliburton, nothing company specific, going along for the ride. Remember, I showed you OIH, Oilfield Services, yesterday. Halliburton, obviously a big player within the services space. On the loser side of the board, VeriSign down 3.3%. Didn't see anything company specific there, but services was a weak spot within tech yesterday. VNO REITs down under pressure, 2.78% to the bad. Pulte, PHM, caught a downgrade at BAML, down 2.7% yesterday. Fortinet, quarter downgrade at Piper Sandler. That stock down 2.6%. And MCO, didn't see any company-specific news to take 2.6% out of that stock. Let's talk about it. The sentiment song remains the same in that options traders are dogmatically bullish, right? And this chart's a little busy. I apologize, but I wanted to incorporate as much information as possible because it really is. I think it's a more neutral stance if you take a compilation of sentiment indicators. And all of these sentiment indicators that I look at are market-based, not survey. I don't like survey stuff. I don't care what you say. I care what you do with your money. So if we take a look at it 3 different ways, equity option, put call ratio, right? Dogmatically bullish, right? We've been in this range for months. I don't know what more to say. You're hearing about it. You're hearing all about the retail traders that are bulled up just buying call options, lotto tickets. Fine. If that's worked, great. But at the same time, the VIX has remained stubbornly above 20, right? Even as the market's grinding higher, even when the S&P closes the year at an all-time high, the VIX stays above 20, right? So that's 2 different pieces of information there. With the put call ratio dogmatically bullish, but the VIX not exactly breaking down. So that's kind of interesting. And then the CNN Fear and Greed Index, which I've given you over here, I copied it right out of the right off their website, is neutral, and it's been neutral for a couple of weeks. There are 7 market-based metrics that go into developing this index and coming up with this number. A couple of weeks ago, we were way down here. We were extreme greed, fine. And now we've backed off. And now we're neutral. So it really is a mixed bag, right? Uber bullish, skeptical, right? Fearful, neutral, right? And so that's the same week over week. I know we weren't here last week, but I look at the data and it was the same week over week. So it's kind of interesting. I think it's a little more mixed, right? You hear a lot about how frothy it is out there. Well, this data doesn't point to super froth, right? Which is why I say some froth has been skimmed off. When we were, in the 80s and 90s over here, sure, fine, frothy, not so much anymore. Looking for dividends. I don't really focus a lot on dividend plays, but I think it's kind of interesting because I think there's a dynamic playing out that money's leaving the treasury market, but it still is looking for an income component. So you're looking for some, maybe if you're willing to go out a little further on the risk spectrum. Now we've talked about this within fixed income, but within the equity landscape, fund like RDIV, which has a bullish rating here at Chaikin Analytics, is a 4.9% yield. Now I will kind of caveat it with, it doesn't trade a lot. Assets are there, right? 600 million in assets is not huge, but not small, but not the most liquid of ETFs. So just factor that into your work going forward. But, we have a fund here that's in an uptrend above the 50-day, above the 200-day. RSI, I blocked it off here a little bit because I wanted to give you more information, but we're in bullish ranges. And the scooter here with a 72 number looks somewhat interesting. So I think that, if you're a diversified investor and you're kind of worried about the yield that's out there within the fixed income landscape, if you're willing to go out a little bit further on the risk spectrum, you may want to take a look at this with further analysis, right? I'm highlighting it. You have to know what's best for you, a little further analysis. And again, I think what's happening, I think we're seeing that play out as yields move higher. This is investors leaving treasuries and then looking for opportunities to still generate yield, but perhaps have to take on more risk to do it. It's kind of a working thought that's in my head. It's been in my head for a while. Wanted to kind of play it out here. Feel free to let me know what you think. I'm widely available on social media if you're following me on Twitter. So that's it. Take us for a test drive, shaikinanalytics.com/test drive. Hope everybody's having a great week. Happy Wednesday. I will be back with you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.